Hello, everyone. Good morning to you all, and thank you for the invitation to present to you today. My name is Jonathan Sims, and I'm one of the senior analysts on the Power and Utilities team at Carbon Tracker Initiative. My apologies for not being able to present this live, but I'm very pleased to be able to share this recorded presentation with you. Today, I will be taking you through some of Carbon Tracker's research on the energy transition from fossil fuels to low carbon technologies, and we'll be highlighting some of the financial risks that we foresee arising from this for power sector gas-fired generators, particularly over the coming years. Firstly, I'd like to give a quick introduction to Carbon Tracker Initiative. We are a financial think tank that carries out in-depth analysis on the impacts of the energy transition on capital markets and the potential investment in high-cost, carbon-intensive fossil fuels. We have a vision to help facilitate global energy markets to become climate secure for the future by highlighting how capital markets need to align with climate reality. That is the need for sectors to decarbonize in sufficient time periods to keep the global temperature rise from pre-industrial times well below the 2 degrees levels specified in the Paris Climate Agreement. We want to do this by empowering investors to divert capital away from the highest cost, most polluting fossil fuel projects, by engaging with companies globally to reassess the viability of their projects once the energy transition backdrop is fully considered, by helping both financial markets and policymakers to fully understand the risks of a disorderly transition, and by working with financial regulators to improve the levels of transparency on risks brought by the energy transition. I'm going to split my presentation into 3 parts. I'll firstly provide a bit of a brief explanation on how our data modeling works and hopefully explain some technical terms which may not otherwise be clear in later parts of what I speak about. I'll then talk a bit about events this year, which have driven levels of energy price volatility never seen before, and comment on how this has impacted the outlook and viability for long-term power sector gas use. And then I hope to focus the final part of my talk on the specific risks facing investors looking at power sector gas projects in Asia and the challenges that are likely to be faced if such parties continue to allocate large amounts of capital to the sector. So if I firstly give an explanation as to our modelling and how we look at financial risk for power sector generators with the climate backdrop in mind, we base our asset level modelling on 2 key climate scenarios set out by the International Energy Agency. The Beyond 2 degree scenario, which outlines the pathway by sector required for the global temperature rise to remain well below 2 degrees. And then the net zero scenario, which outlines the pathway for each sector to the world reaching a carbon neutral position by 2050. We calculate the maximum amounts of remaining coal and gas-fired power generation that is permitted in each year under these scenarios, and assume that if policymakers press ahead with enforcing the necessary emissions reduction, that it will be the costliest units that are phased out and retired first. Assuming that these units forced to close earlier than planned owing to climate policies were still generating profit at the time of their closure, otherwise would have closed sooner if already loss-making, we then measure the amount of potential future profit that will be lost to the plant owner through early retirement compared with what would have been earned if the unit had been allowed to run for its full planned lifetime under business as usual. The difference between the profits generated under business as usual and the climate constrained scenarios is what we refer to as stranded asset value, and can be seen on the right-sided chart here as those grey shaded bars which will be lost to the majority of power sector gas generators who will be forced to end operations around 2035 in advanced economies to align with a net zero scenario. We use this metric to both encourage the owners of already operating gas-fired power stations to plan orderly wind downs of their assets in such a way that maximizes shareholder return, but to also highlight to any current developers of new gas plant projects that a significant amount of investment will be lost if you press ahead with such schemes now, as the business models for them is just no longer there. We also calculate the current net present value of planned future coal or gas power stations and assess whether such schemes are viable investments through this metric, which measures all estimated future cash flows of the project. Projects which produce net present values that are greater than their estimated weighted average cost of capital create value for investors, whereas a project which has an NPV less than its weighted average cost of capital destroys value and should be cancelled or else risks significant levels of capital investment being lost. When considering stranded assets, we look at three key inflection points with our recommendations to policymakers and investors. The first one is the point when new renewables become cheaper over investments in a country than building new coal or gas. This rush should be a clear signal to policymakers in that country to stop funding the construction of new fossil fuel-fired power stations and for investors to stop piling capital into such projects. Our second inflection point is then when new renewables by themselves become cheaper to invest in than continuing to finance the country's existing coal or gas plant fleet. And this is the point where policymakers can start thinking properly about the phase out of their power sector use of fossil fuels in line with long-term climate targets, knowing that cleaner and lower cost technology alternatives are now available. For investors, this is the point at which they should be rapidly withdrawing their involvement in any remaining fossil fuel-fired asset in that country, given the high likelihood that the asset will be outcompeted by renewables in the very near future. We do, however, acknowledge that flexibility still remains key to the functionality of global power grids and their ability to successfully meet demand. And so our final inflection point is where we see dispatchable renewable capacity, so solar or wind farms with battery storage capabilities, also outcompeting coal and gas power stations on cost, leaving such fossil fuel assets completely obsolete to the system. And that final point is where a phase out of fossil fuels for power sector use should already be fully underway, and is the point at which investors will no longer be receiving any returns at all from fossil fuel assets they may still have capital invested in. So having touched upon how our methodology works in practice, I'd now like to turn to the recent energy price volatility we've seen and the impacts that this has had on the power sector transition outlook. The repercussions of Russia's invasion of Ukraine have seen gas prices spike to record levels, with the EU taking steps to cut its imports of Russian pipeline gas, and Russia in turn reducing its flows of gas to Europe. These events came at a time when there were already high levels of price volatility in global gas markets, as a slowdown in production during the COVID-19 pandemic meant the supply just could not keep up with rallying demand during 2021 as economies recovered. But even from these relatively high baseline numbers compared with previous years, market prices for the Dutch TTF hub, which provides Europe's benchmark gas price, have trebled since the start of 2022. This is particularly alarming, considering we have not yet entered into the key winter months, and fears are building of how high prices might spike towards the end of the year, especially in the event of any cold snap period. This situation has forced European political leaders to urgently seek alternative sources of gas to replace imports from Russia, which made up 40% of total imports last year. And this has resulted in a dramatic increase in Europe's demand for liquefied natural gas, LNG, which has significant knock-on effects for nations that were already heavily dependent on this market. But I will touch upon this a little later. The gas market price spike has had a significant knock-on effect into Europe's wholesale power market, which remains extremely dependent on gas, owing mainly to a failure by policymakers to incentivize low-carbon capacity deployment at a quick enough pace to adequately replace the continent's retiring coal-fired power stations, which are being phased out extremely rapidly. I show here on the chart the year-ahead power price for Germany, which in August reached levels 7 times higher than where it was trading just a year ago. And bear in mind that this is the baseload price, so essentially an average of all hours in the day, meaning that the peak demand evening hours built within this contract are going to be much, much higher. We believe that this year's energy market price volatility and the high wholesale gas prices we are currently seeing have shifted the outlook for gas's future role within global power systems. Gas prices appear likely to remain high for the foreseeable future, given the tightening supply availability. And it is clear now that nations should be taking steps to reduce their exposure to this market to avoid locking domestic consumers into a long-term future of high energy bills. Just to quickly demonstrate how quickly the situation has changed this year, I show on this slide two charts which are based on the modelling work we produced for a report we published in early February this year, focused on Poland's plans to build a whole fleet of new gas-fired power stations. We highlighted in that work that clearly now is not the time for nations to be committing to new large-scale gas projects, both in terms of a cost perspective, with new renewables increasingly competitive in Poland, and an energy security perspective, given the tensions that were building at the time. But the gas price moves we have seen since publishing that work have shown beyond doubt that committing to new gas would be a disastrous strategy. And we show in the top chart here just how far prices have moved above our base case assumptions for gas prices in that project. And then in the lower chart, we show in red our estimated short-run marginal costs for new gas plants in Poland today, against the yellow shading behind it, which represents solar PV costs at the bottom, up to onshore wind with battery storage capacity at the top. You can see there that we projected new gas to be competitive still with those dispatchable forms of renewables, but actually based on average gas prices over the past 6 months, we show in the far right-sided yellow bar where operating costs for new gas in Poland will actually have turned out. This essentially means that those inflection points I spoke about earlier in my methodology slides have now all been passed in Poland, and this period of gas price volatility we're experiencing is accelerating the rate at which fossil fuels are outcompeted on cost by renewables. So I'd now like to turn my attention to Asia for the final part of my presentation and take you through some of our recent work exploring the financial risks of long-term power sector gas investment in the continent. We believe that events in Europe this year will have significant ramifications for energy markets globally, but believe that Asia will be particularly impacted owing to its dependence on LNG for its gas fuel supply needs. The dynamics of the LNG market are changing by the day, and where trading was previously dominated by Asian buyers, we are now seeing shipments previously destined for Asian ports diverting towards Europe. Market price volatility for Northeast Asian LNG shipments had already been hugely volatile over the past year, owing again to the market upheaval and demand swings triggered by COVID-19. But the increased competition for cargoes we are now seeing is close to pulling prices above those record levels seen just under a year ago. Now, these are spot market values, and we fully accept that the majority of power generators and gas-dependent industry in Asia would have secured their fuel supply shipments at much lower prices several years in advance on long-term contracts. But we were also seeing some Asian buyers short on supplies being forced to buy on the spot market, with Nippon Steel recently paying the most ever for an LNG shipment into Japan. Long-term contracts protecting power generators and industry from the current high prices and volatility will also reach expiration at some point over the coming years. And given the increased competition for LNG we are now seeing and the market's changing dynamics, it appears unlikely that prices will have significantly decreased by the time it comes to renew those long-term supply contracts. The LNG market's volatile nature and the risks of long-term exposure to it provided the basis for a report we published earlier this year entitled "Stop Fueling Uncertainty: Why Asia Should Avoid the LNG Trap." We concluded in this research that long-term dependence on LNG or gas of any form the power sector needs is increasingly risky, and that Asian nations should now be planning to reduce, not increase, their exposure to these markets. Any new gas plant capacity built now will lift consumer electricity bills, and in terms of investments, will be value destructive and result in a significant amount of capital stranding over the medium to long term. And instead of planning future power systems around the long-term use of gas, we concluded that Asian nations should grasp the abundant potential they have for renewable energy sector expansion, particularly in the offshore wind sector, with vast sea territories and strong wind speeds offering perfect conditions for growth in this area, where costs are rapidly falling. So for this report, we modelled the economics of both new and existing power sector gas plant capacity in South Korea, Japan, and Vietnam, and compared operating costs for these units against those for new renewables. I emphasize here that we believe that the risks of building new gas infrastructure of any form have never been higher than they are today, and that Asia's dependence on LNG makes it particularly exposed to the current price crisis we are experiencing. Gas plants operating in Asia will be facing the greatest levels of competition for their fuel supplies than at any point in the past, and so we do not forecast any decrease over time in the long-run marginal cost of running either new or existing gas plants for South Korea, shown here on the chart in the black and grey horizontal lines respectively. The grey bars on the chart then represent the estimated levelized cost of energy for new gas plant projects planned in the country, referenced by the year that they are due to start up. When using current prices for LNG, we project that any new gas plant projects starting up in South Korea now will be uncompetitive with solar, onshore wind, and even solar with battery storage capacity from day one, while new plants will also be outcompeted on cost by new offshore wind farms built from 2025 onwards. Both solar with storage and offshore wind are also projected to become cheaper overall investments than continuing to run South Korea's existing gas plant fleet by just 2024 and 2025 respectively, meaning it appears possible to start planning the phase out of power sector gas use in the country in line with its 2050 net zero target, knowing that dispatchable renewables are imminently going to become available at lower overall cost to the system than continuing to run fossil gas. So on the chart on this slide, we show estimated average revenues for the operating gas plant fleets of South Korea, Japan, and Vietnam against the diagonal coloured lines, which represent the new gas plant projects planned for build in the countries. For these projects to break even, they will require their operating costs to remain below that dotted line, indicating expected revenues. The 0% line marks our base case assumptions for our stop fueling uncertainty research report, which were based on fuel prices recorded over the 2019 to 21 period. So from this, we can see that it was likely that new gas build in these countries was already likely to be unviable investments owing to insufficiently high revenues. What has become clear since publication, however, is that operating costs are now much closer to those red levels at the far top end of the coloured lines, given the gas price spikes we have experienced. And this essentially means that new gas units built in Asia will need to generate significantly higher revenues than in the past to break even, meaning that pressing ahead with these projects will result in high consumer energy bills in the long run. We believe that these projects should be cancelled now to avoid locking consumers into these high bills and long-term exposure to the LNG market. Additionally, given the net zero by 2050 targets in place in these countries, new gas plants are unlikely to enjoy the long 30-year lifetimes that they have in the past, meaning that units may be forced to close even before original debt is repaid and capital costs are recovered. As a consequence, we project that across these three countries, a combined $69 billion is at risk of value destruction through investment in new power sector gas plant projects over the coming years. The vast majority of this is expected to be from projects based in Vietnam, but still some $11 billion is projected to be at risk if the new gas plant projects planned for build in South Korea proceed to development. I'd like to just briefly turn attention now to Vietnam specifically, which clearly stands at a much earlier stage of maturity in its gas power sector development than South Korea and Japan, and is attracting international investment interest into potential opportunities there over the coming years. Much of the messaging directed towards Vietnam in our reports was focused more on highlighting to policymakers the extreme financial risks posed not only to new gas-fired power stations in the country, but also to the extensive network of infrastructure required to be built to support a new gas-dependent power sector if the country opts for this route as it begins its path away from coal. Vietnam has plans to increase its gas-fired power generating capacity more than fivefold over the coming years. And as I say, this will not only require investment at the power plant level to deliver, but also significant levels of additional capital investment in the infrastructure needed to receive and regasify the LNG necessary to refuel the new capacity. All of Vietnam's existing gas plant capacity is fueled by domestic gas supplies rather than LNG. This essentially means that Vietnam's proposed gas plant projects are only viable if additional capex is spent on related LNG infrastructure. That said, even before these additional costs are taken into consideration, we project that as much as 98% of the planned pipeline is unlikely to be able to recover its initial investment, owing to insufficiently high power market revenues, unless the Vietnamese government provides power purchase agreements to the projects. This will, however, require Vietnam's electricity tariffs to be raised significantly to levels which are at least equal to the levelized cost of electricity for new gas. And given that the LCOE for new renewables is either already lower or will fall below that of new gas within the next year, PPAs for new gas, which lift consumer electricity bills, appear difficult to justify and should consequently be discarded. Essentially, this planned pipeline of new gas plant projects in Vietnam appears headed for economic disaster and should be cancelled. We believe that Vietnam's vast natural resources and potential for continued rapid development in the renewable energy sector instead provides the country with the opportunity to leapfrog gas as a primary energy source and plan now for a coal to clean transition. Just before I conclude, I would like to end my talk on a positive note. The opportunities for Asian nations within the offshore wind sector going forwards was one of the key messages we brought forward in our recent report. And this chart shows how quickly we foresee costs for the technology falling in South Korea, Japan, and Vietnam once the first few projects are developed. We have seen similarly rapid falls for other renewable technologies historically once they have started to be built at scale, and we believe offshore wind will follow a similar pathway. The green shaded area here represents the range of projected operating costs for the new build gas units planned in the region, and we can see that offshore wind costs could fall below the cost of running the majority of new gas plant projects before the end of this decade. We also believe that our estimates represent fairly conservative estimates for offshore wind operating costs, given that offshore wind farms are already being developed in Europe at cost levels of only around $80 per megawatt hour, while globally the average for the technology has already fallen below 95. Even in Asia, despite the lower levels of capacity thus far, we are seeing costs at comparable levels to this, with one Japanese project developer accepting a power purchase agreement at a price of only just above $100 per megawatt hour last year. South Korea's offshore wind potential is particularly huge, not only given its sea territory, but also given its existing maritime sector expertise and port facilities, which we believe lay the foundations for rapid sector growth. Offshore wind farms can deliver capacity factors of more than 40%, with this figure projected to reach levels well above 50% by the end of the decade, as turbine infrastructure continues to improve, meaning reliability and production levels are comparable to that of gas plant facilities, even without storage capacity installed. We have seen this year just how quickly the geopolitical landscape can be altered and how gas supplies can be either weaponized or placed under international sanctions, And so planning a power system centered around generating electricity domestically, making use of natural resources, and thereby minimizing exposure to commodity price risk should be an urgent priority for policymakers globally. This strategy will not only have the advantage of helping to align nations with their net zero 2050 targets, but also now in improving their national energy security. So that concludes my presentation. Thank you very much again for the opportunity to speak to you today. Please do get in touch with me if you have any questions or would like to receive copies of any materials I've referenced here. All of our research is available for free and can be downloaded via our website, so please do take a look. Thank you again, and I do hope you enjoy the rest of the event today.